Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hey everybody, welcome back to the Investing Podcast presented by Tusk Media. We're going to jump in just a second and talk about Boeing and their earnings. We're doing things a little different this week. Basically doing a lot of previews and recaps of earnings. So we've done everything from Twitter and Amazon and Google all the way to Boeing and Polaris. Talked a lot about motorcycles and all that kind of good stuff along the way. So check it out. Hit subscribe on YouTube. Follow us on Twitter at Tusk Media LLC because we're going up to a conference this week, and the Invest for Kids conference. We love the kids, doing all we can. Nobody cares more about children than we do. Nobody has more respect for children. So we're going to do that. We're going to tweet about it. We're going to tweet about our adventures in Chicago, maybe even eat some pizza. Yeah. We'll see. We'll see if we can get some authentic Chicago-style pizza, and we'll do a pizza review and see if it compares to Pizza Hut. So that's what we got going on this week, but we'll jump in. Joining me, Ben Nye, to talk about Boeing. Ben, how are you?
I'm doing well. So you talked about motorcycles in the previous segment, I guess. So now we're going a little bit bigger.
A little bit bigger. Hopefully a little bit, hopefully less racist. We wondered if Indian motorcycle sales were down for Polaris, that segment, because of kind of the political incorrectness of the branding there. Especially in an election year, seems like that's maybe why that segment was down. So hopefully we don't run into too many racial tensions when we're talking about Boeing. So
right.
That's the hope. Well,
in Seattle there aren't too many. It's pretty racially, uniform. Talking from as a Seattle, as a guy who lives
he can
in
say
Seattle,
that he's from there.
Yeah. So I mean, you have a large Asian population and you have a small white population. So that's about what you have. So anyway, jumping into Boeing, we have the company's coming out with earnings, and we actually talked a lot about Boeing a couple months ago, really. In July, right around the time of the air shows. Every year, these Boeing and Airbus go to these air shows, sell a lot of planes. This year, they didn't sell quite as many as they have in previous years. So that was something that we were watching. Part of the reason the stock didn't really move up much, it moderated a little bit, fell down to about 128, but right now it's like 137.
Yeah.
So decent performance from Boeing in light of those headwinds. And the reason that performance is doing so well is because people are really buying into what management is talking about. So for the last few years, they've been talking about just watch the cash flow, watch the free cash flow. So if you do that, then all of a sudden you're talking about Boeing at a relatively low valuation. There's some interesting points onto that we can discuss. Part of that is, they're booking some of this cash flow ahead of the time they're actually delivering the aircraft. So I mean that's a difference between the cash flow that could seem like, oh well, they're being so conservative on earnings, but they might be a little more aggressive on cash flow.
Right.
So important to watch cash, but cash is a volatile number. So now they're talking about watch the earnings. So a little bit of a change now that free cash flow is made moderate relative to earnings.
Little magician's trick.
Right. Over time, they admit that it's going to be around 1:1 free cash flow to earnings. So just bear that in mind when they're doing 1.3 free cash flow to earnings ratio. But I wanted to talk about a little bit differently than I know a lot of people are going to be talking about kind of quarter-to-quarter basis. I kind of wanted to look at the larger trends that Boeing is going through and kind of pinpointing where we are in the cycle and what's the drivers of growth for Boeing going forward. Because although that the stock will move on the earnings report, the longer-term move will be based on some of these things that we're talking about. So first of all, let's look at the 15-year revenue growth. So what has been driving revenue growth over the last 15 years? Boeing's revenue, Boeing's top line on the income statement, has grown 65% over those 15 years. 1% of that 65 is due to the United States growth.
USA.
Asia, other than China, is 11%. China is 19%. So Asia overall is 30%. Of the revenue growth, Asia is about half of that. Europe 7%. Middle East is 19%. So you're getting all your growth from the Middle East and Asia.
Right.
So what happens when China starts to soften and oil starts to fall and limits the amount of money that Dubai and the Emirates airline have to spend on new planes? Well, you see that those revenue growth rates decline, which has a negative effect on Boeing. Interestingly, Alcoa came out a couple weeks ago when it reported earnings saying that wide bodies is just a weak market for them. Narrow bodies were doing relatively well, but overall they continue to adjust their guidance down. This is Alcoa, which sells a lot to the aerospace industry. So Alcoa continued to notch their guidance down for 2016 using the term transitional. Now, if anyone's been in this industry for any length of time, if a company starts to use the term, this year is a transitional year, your hackles should be up.
Yeah. Say your prayers.
Because that's code for earnings are going to be down, and we're going to have to turn around the cycle.
It's a rebuilding year, man.
Yeah.
It's rebuilding.
So you can see over time, the United States becoming less and less a part of Boeing's revenue base, and China, Europe, Middle East.
Which I think that, especially on the U.S. side, is interesting because you hear a lot of rhetoric, especially heading into an election in terms of, what are the outcomes if Hillary Clinton wins or Donald Trump wins? And some of the first names that you hear about really are kind of these more defensive stocks, and some of these names. And then you look at that, and it's easy to read through that and generically say, oh, well, Boeing really stands to benefit in this scenario or that scenario. But then the reality is, well, 1% of their growth in the last 15 years has come from the U.S. to begin with.
Exactly.
So a real boon there maybe is 2%.
Yeah.
That's not really going to be a driver.
And so 15 years, obviously, that goes back to about 2001, where there was some weakness in the U.S., but even if you adjust that, still low mid-single digits. So that's that piece of it. Then the next piece is you have to look at backlog, because backlog really determines, people like to buy the stock when the backlog is rising, because that means that expectations are growing and growing and growing for the future, and you don't really have to rely on operations to actually deliver on that backlog. You can kind of just look toward the promise of future growth. When the backlog starts to flatten off or even decline, that's when it's put up or shut up. That's when Boeing needs to come through and say, and actually deliver on the obligations that they have to their customers. So backlog started to level off at the end of 2014. And it's kind of been on this gradual glide path ever since then. Because it's so vast, a $400 billion backlog, $450 billion backlog, it's difficult to really discern quarter-to-quarter trends in that. What you can look at is orders. Now, Boeing produces orders results monthly, so you can actually go to Boeing's website, which is where we got this data, and actually see, how many orders they have even before the quarter is reported. So that is already public information. You don't have to react to that necessarily when they report earnings, because that's already out there. So we actually graphed it through the third quarter of 2016, and we just continue to see this glide down, not as steep as we saw at the beginning of the year, but it does continue to be in the negative direction. Coupled with that, so not only are you seeing a decline in the order growth, but you're also seeing a rise in CapEx. And they're producing the 787, and they really want to ramp up production of that in order to bring the cost down. And when you sell an airplane, you book margin with it based on, you allocate the R&D to those aircraft. The way Boeing does it, they don't expense that ahead of time. So to the extent that they can't get the volume up and get those costs down on a per unit basis, they could be seeing some severe write-downs for this new program. So then if we look at street expectations for Boeing, so instead of using the quarter-to-quarter data, Boeing's an extremely long cycle company. So I would advise, or I would recommend, I would advocate for putting a greater emphasis on the year-to-year trends in EPS. So you can see that despite the decline in margins that have taken place over the last couple of years, the expectation from the street is that margins will rise, and a lot of that's based on the maturing of the 787 and almost a lack of investment in new products. But of course, Boeing's not going to do that. I mean, Boeing's going to continue to expense and increase the R&D expense on
You're not going to
new
stop there.
products.
Just
Exactly.
pause. This one's perfect.
Yeah. So look out for that. Look out for the EPS number, which is expected to be $9.50 next year. And a large part of that is due to a tremendous expansion in the net income margin for the business. So to the extent that that's not going to come through, to the extent that you see costs rising on a per unit basis for these aircraft, watch out for the Boeing stock, because to me, that's the biggest risk that they face at the moment. Of course, the positive flip side, always got to look at both sides. Bull case is that they are able to deliver this, and this is a stock that's trading at 13, 14 times earnings once they start to mature.
So there you go. That's the outlook on Boeing. Keep an eye on those things, kind of those nuanced items, as opposed to maybe just the quarterly expectation,
right?
Which we've talked so much about. And I think you're exactly right. You kind of hit on this early in the description. So it's not a stock that's probably going to overreact just to the earnings on a quarterly basis. So kind of that long-term view and some of the read-throughs of all the data available there would definitely be prudent to look at. This is the Investing Podcast, and we'll be back later this week.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.